Welcome to CRE Fast 5. I'm Carly Iacono, and tonight we are diving into investor return metrics. It's crucial that you understand the difference between capitalization rate, internal rate of return, and net present value. I'm going to walk you through the pros and cons of each model and help you understand when you should be using each one. Let's go. The first and most widely used is capitalization rate or cap rate. Likely this is something you already know how to calculate, but if not, it's the net operating income divided by the current value or purchase price of your property. Cap rate is a snapshot in time. It does not contemplate any changes of income or expenses throughout your whole period, nor does it take financing into account. So again, it is an unleveraged return in year one. Cap rate is extremely easy to calculate for net lease because typically there are little to no expenses and your income has a predictable growth pattern. So this will be, if you're a net lease investor, your most common metric and one that you should already be incredibly familiar with. The next model is the internal rate of return. IRR is the sum of all future cash flows and the profit you expect to receive on resale. Because the model looks at each year individually, you can account for any expected changes in income or expenses. This is especially useful if you are an investor of multi-tenant retail or maybe office where you have a lot of different tenants whose leases are rolling on different times. Maybe you have expense obligations in way of taxes or financing or anything related to your property that is not consistent year to year. So IRR allows you a lot more flexibility of your inputs into the model. That said, of course, the data out is only as good as the data coming in. Because there are so many variables, very often a small tweak to an IRR model can give you a very different rate of return on the output. Now, IRR is solving for a percentage or an expected rate of return over that whole period. However, note it is a compounding interest model. So the model assumes that any interest you receive, you are reinvesting at the same rate of return that IRR model predicts. So if your model says your investment is an 8% internal rate of return, the assumption is that every year you are taking your net operating income and the interest received and reinvesting it at 8%. If that's not the case, let's say you're an investor and you take your net operating income and you put it into a money market account and you're actually getting 2% each year on your money. Your true rate of return is not going to be the same as what that IRR model predicts because you are not reinvesting at the same rate each year. Thereby, the compounding information or compounding total will be dramatically different. So keep that little known fact in mind. And again, IRR is helpful from a broad picture, but any small tweaks to these variables can dramatically change the output. So use it as part of your overall investment analysis and not the only metric. The third one, and probably the most misunderstood, is net present value. NPV is the current value of all future cash flows on an asset. NPV is not solving for a percentage return. Quite the contrary. In fact, when you do an NPV calculation, you actually have to input the discount rate or rate of return as part of the model. Now, the discount rate can be looked at as the opportunity cost for the investment. So if you're comparing investment A and investment B, you might use a discount rate of 6% when you're looking at investment A because that's what you think the cap rate is on investment B. So think of your discount rate not as the interest rate, don't make that mistake, but as the opportunity cost on the value of your money to take that money and put it into this particular investment. Now, when you run a net present value calculation, it's a bit complicated. Usually it's done in Excel. You're going to be solving for a dollar amount. Now, if you get an NPV of 0, that does not mean that there is zero value to the future cash flows on your asset. Instead, it means that the future value of the cash flow equals the discount rate or rate of return that you put into the model. So again, if you use 6% as your discount rate in the model and you come up with a net present value of 0, that means the future cash flows are discounted back at a 6% rate of return, and that is your expected return on the asset. If you come up with a net present value, let's say of $18,000 after you run your model, that means that you can pay $18,000 more for the asset and still hit that 6% return metric. Now, if you come up with a net present value that's negative, that means you need to pay less for that asset to hit that same discount rate or rate of return. So it is a useful model, but again, not very often used in net lease because the calculations are a bit complex, and tweaking that discount rate even a little bit will dramatically swing your net present value calculation output. If any of these are confusing or you'd like to talk them through further, feel free to give me a call. I'm happy to help you out. That was CRE Fast 5. I'm Carly Iacono. I look forward to seeing you again soon.